Hey guys, this is Chris Mincolla with the Mincolla Group at West USA Realty, and we've got our Wednesday Facebook Live, Mincolla Group Live, with Evan Einhorn today at Modern Home Lending, and he's actually the owner, operator of Modern Home Lending.
Yes.
And we've got him in today, and he's going to be talking about how to get started with the steps to getting qualified for or pre-approved for a home loan.
Right.
You want to kind of start us off with that? Guys, don't forget to like, follow, and subscribe to us, and be sure you're asking questions, all right? That's what we're here for.
Yeah, so we'll talk about, one, what the process is, and two, what we look at. You know, because I think people are like, oh, yeah, I mean, I'll give Evan a call, but what are you guys actually looking at? Like, people kind of want to know behind the scenes before they start talking to me.
Absolutely.
And Chris, you know, I mean, how early should people start getting qualified? I mean, I know this, but as a realtor, I'm sure clients come to you all the time at all time zones.
I would say now.
Yeah.
Now, and the reason why I say that is, yeah, you know, you could say 90 days or whatever, but, you know, for one, you're going to be in a better position financially with your credit and everything if they start working with you earlier rather than later.
Right.
And avoid any hiccups or issues that may pop up under credit or with debt to income ratios. But the other thing is, you know, they may be in a lease and their lease ends and they may not be able to go month to month.
Right.
And even if you can, they're probably going to charge you more. So you want to make sure you get this done as soon as possible. I would say at least 3 months ahead of time.
Yeah, 3 to 4 months. You know, if we run credit, it's good for 4 months. Even if we don't need credit, you know, even if we don't want to run credit, I can still talk to you 6 months, a year out, just to make sure we're taking the right steps. And like you said, credit is one of them. But another thing too, like I've met some people, first-time home buyers that have had great credit. They were set to go, but I told them, hey, you should probably buy before you get that raise at work because you qualify for some special programs. So that's just one example of me saying, hey, or someone else who was considering opening up their own business, and I'm like, hey, you should probably buy before you do that, because if not, you're gonna have to wait another couple of years.
Absolutely.
So as far as how to get qualified, you know, we offer 3 options. One, our online application at www.modernhomelending.com. 2, a quick 10-15 minute call with me. And 3, you know, if you want to meet in person, you can do so at my office. We can set up a time to meet. Give me a call first. All the contact information's on modernhomelending.com. And basically what we're going to be talking about, it's kind of like a mini loan application. It's, you know, a lot of people think, oh my gosh, it's a lot of paperwork, but no, it doesn't have to be. It's actually all online or on the phone or with me in person. So we actually don't have a paper application. You know, and basically, you know, we're going to be going through 2 years of residential history. So where have you lived for 2 years? 2 years of employment history, 2 years of income history. You know, other small questions. Are you married, single, you know, date of birth, social, that kind of stuff. I don't know if you've ever watched the State Farm commercial with Jake from State Farm.
Yeah.
Kind of the same kind of stuff. I always like to joke that.
Absolutely.
So that's the information that we're going to be getting. No documentation up front. So we're just getting the loan application. And the reason we do that is because we need different documentation for every person. I might need you know, a lot of people think they need tax returns. We actually don't need tax returns. We need tax returns for only about a quarter of our files. So there's no reason for me to ask you for documentation if we're not going to need it. And sometimes there's unique situations where, yeah, we do need that child support order, you know, if we're using that as income. And I would have no idea to say, hey, Chris, you know, make sure you get me your divorce docs and child support order if, you know, I didn't even know you had a child support kind of thing. You know what I mean? That's just one example. So the first step of the process is going through that loan application. Second part of the process is reviewing options and collecting documentation. And we make it easy, Chris. I don't know if you've ever sat with one of our clients, but you know, you could either fax it to us, you can email it to us, you could upload it to our portal, you could connect your bank accounts or HR accounts, like your payroll, to our portal to make it easier. So a client could get us all their docs in under 60 seconds, which is amazing with technology.
Yeah. I've seen the portal and the online stuff because I send it out to our clients or post it. And,
Right.
And it's really easy to use, real simple to get started. For people who, today a lot of people don't want to get on the phone or they don't have time and, they want to do stuff at off hours. It's a great way to get started.
Right. So as far as the process goes, like I said, application that's either on the phone, online, or in person. Second part is reviewing options or documentation. And if for some reason we're not qualified, we're going to set up an action plan.
Right.
But I'm going to talk about, getting qualified in this episode. And then, as far as what we look at as a lender, because, every conventional loan, every FHA loan, every VA loan, they have the same guidelines. With some banks and stuff have extra guidelines, maybe to get a better rate or something, but they all have the same guidelines. So the three things I say we like to look at are assets, income, and credit.
Right.
So I'll start with income. Self-employed borrowers are treated differently than, pay stub W-2 borrowers. Commissioned employees are treated differently than like a salary or hourly employee. And each of those loan programs have different income requirements too. So, I know you hear debt to income ratio a lot, but I know the average consumer may have heard of it, but doesn't exactly know what it is. So on a high level, I'm going to give you guys an example for someone that makes, just to make math easy, $10,000 a month, a nice round number. So someone making $10,000 a month, which I know is more than the median income, but someone that makes $10,000 a month, on a typical conventional loan, they're allowed to have $5,000, 50%, so basically half their income, to go towards all their monthly payments. So let's say it's a married couple, maybe, that has $10,000 of income together. Maybe they have $1,000 of car payments. Maybe they have $1,000 of student loans and credit cards and, installment loans and other kind of payments. That leaves $3,000 as far as a mortgage payment left over, which is well over $400,000, $500,000.
Yeah.
So, a lot of people think, hey, they're like, what do I need to qualify? What kind of income do I need to qualify? But it really depends on how much debt you have too. Because I've had people qualify for a $450,000 home with little down, with $50,000 income a year, but they didn't have any debt. And I've also had people that had $50,000 income that couldn't even qualify for a $50,000 loan because they had too much debt in their name. So that's how we look at income. We look at how much income do you have, and then of that income, how much are you already using towards debt?
Right. And one of the things that I hear a lot from people is, well, I'm working with the credit bureaus, or I'm checking, whatever online for my credit score. And it's a little different when you run it, because you're looking at all these different factors. You're looking at,
so I'll get into that. Our credit scores are definitely different.
Yeah.
And income too, like versus auto loans or credit cards or whatnot, like I've had people tell me they've got denied for credit cards or auto loans, but they get approved for the mortgage. So everyone, mortgage is a whole different animal. There's so many different guidelines. There's so many different programs out there that I might tell someone, hey, you don't qualify, you're not going to qualify for FHA, but you can qualify for conventional, or vice versa.
Yeah, and for somebody who hasn't bought a home in a while, but maybe bought a home in the past, some of this may be kind of new.
Right. I'm sorry, I'm at a coffee shop, so if you hear some background.
I thought you were at a racetrack. No, I'm just kidding.
But yeah, some of it,
That's Angel, by the way. I want to, or Steven, I'm sorry. Steven, how you doing? Thanks for joining us. That's my trainer, guys. All right. Anyways.
So, a lot of people don't actually, a lot of people think, oh, I can just say I make this, but no, we got to document it now. Now, with that being said, I did want to mention that we do have some programs where we don't verify income. And those programs are for investors putting more money down. So strictly investors. And then the other is for someone that has a lot of assets, So if you're putting 40% down, have a lot of assets, we actually don't need to verify income. As long as you have enough assets to do so. So with that being said, you will help review all options. So income, you need. Let's move on to credit. Because I think a lot of people, like you said, Chris, they have good, bad credit, etc. Someone might say, hey, on my monthly Capital One card, it says I have a 580, but when I run it, it could be a 640.
Right.
Or the difference between an 800 and a 740. So, there's so many there's over almost 50 different credit score models that, don't let those scores scare you. I mean, yeah, if one's at 800, one of them is probably not going to be at 500. They're going to be within the same realm. But I have seen differences where one's at 700 and one's at 760.
Yeah.
There could be some discrepancies like that. So as far as credit goes, I know a lot of people think you need, something in the 640s, 660s, but that's not the case. So
You've actually gotten people qualified for us below below 600 at 580 credit score. I think even below.
Yeah. So typically what I like to say, if you have a low down payment, or if you need any down payment assistance, you're looking at least 580. If you have a large down payment, there's programs below 580. So it may or may not make sense for you, but that's where, hey, I lay out the options and say, hey, here, this is what you're qualified for. If you want, we can help you get to 620. Here's how much of a better deal that was going to get you. It might or might not at all. So.
Yeah, one thing real quick, too, to back up for a second, not to get too far off topic.
Yeah.
You were talking about income before. One other thing I just thought of, too, that kind of factors into that a little bit. Qualification is, okay, you figure all that out to get the loan amount, but then there's other factors, right? There's insurance, taxes, there's HOA, possibly a solar lease that may be on a house.
So
right?
Yeah. So basically, a lot of people think, hey, I'm qualified for 200,000. Well, realistically, that's not it. It's you're qualified for a certain payment. So you might say, hey, we're qualified up to 1,500. If you found a $200,000 condo that has a $1,000 HOA, you're not going to be qualified for almost anything.
Right.
If because that $1,000 HOA is eating into your monthly payment. So that's a big thing.
Yeah.
So that's something as far as your income. We qualify you, like I said, that one couple that had $10,000 income, $2,000 a monthly debt, $3,000 left over for mortgage. If they have an expensive HOA and a solar lease, that'll eat into your qualification.
Right.
So the less HOA, the less solar lease, the less payments you have, the cheaper your taxes, the cheaper insurance, the more your mortgage that you'll qualify for is.
Yeah, so. And also, see, on the credit side, to get back to the credit, along with that debt and income, that's why a lot of times we'll tell people don't go buy furniture yet or a car yet until we get through closing, because it can change your credit score, right? If you go into debt, correct?
Right. So that's something I always, my goal is to help you see where you're at now. Is there anything we can do to improve it? And I'll let you know if we can. Or if it's going to take too long to improve, then I might say, hey, it's really not worth the wait. But so we talked about income. Let's talk about credit. Like I said, 580 is typically your minimum. Obviously the higher the better, but some programs are more lenient on credit. Conventional loans, you need at least a 620. We do have loan programs under 580. The average American credit score is about a 670. The average home buyer, I think, is about 720, 730. But that doesn't mean you can't buy a home. I think a lot of people are, discouraged because they think you need that 720, 730. So that's not the case. And then the third category is assets. So, we do have loan programs where we can get your entire down payment covered. But, I'll help you look at, hey, if you're trying to go with a conventional loan, you'll typically need 3 to 5% down. If you're looking at an FHA loan, you'll need about 3.5% down. But we have 7 different down payment assistance programs too.
Yes.
So this one, the more down payment, the more you'll be qualified for, just because you're a stronger borrower. But, I'm not afraid of helping someone that's, paying $1,600 for rent now, maybe doesn't have 7, 8, 9, 10 grand around, buy a home, put a couple $1,000s down, and their mortgage is similar to their rent. So assets is the third category. The more assets you have, the better. But at the same time, don't think you need a lot of assets, because I've helped veterans, they actually get money back at closing. And then same thing with down payment assistance. If we get your entire down payment covered, and Chris gets all your closing costs covered, which he's good at, negotiating from the seller, then you could walk into the home, paying your inspection, appraisal, and getting some of your earnest money back.
Yep.
So, yeah. Anything else that that you think the average person should hear?
Obviously, you don't want to switch jobs without talking to you, or starting a business without talking to you, because there are certain regulations there, correct?
Right. So there's definitely certain rules. If you're switching industries, let's say you're going from a job where you're making $5,000 a month, and now you're going to a job where you're making $2,000 a month, but you might be getting a lot of bonuses. Well, we don't know the history of the bonuses, so unfortunately, to start, we're probably gonna have to use $2,000 a month income, which that you're not. You're gonna be making way more, and you're not gonna qualify for much. So that's something. But at the same time, if I've already pre-qualified you and whatnot, we can talk about a possible job switch and say, hey, I'm thinking about switching jobs. Here's what I'm looking at doing. And I've had people switch after they're under contract because they're going from a similar job to a similar job, or even the same industry, higher paying job. So definitely case by case situation. If you look at the FHA guidelines, they're over 1,000 pages. So that's really my job to know those. It's almost, I don't want to say it's quite like an attorney, but like it's on the same level. I just don't have to know all the laws. But yeah, all these programs, all the guidelines are hundreds of pages, and that's where talking to a good mortgage expert is really the key. So
yeah, and I think that's really the bottom line, is we need to get them talking with you as soon as possible, and make sure that everything works out. But one other thing I would add to that on the assets is, if they own a home, obviously we can figure out what the home would probably sell for, what the value would be, what it's probably going to appraise for.
Right.
And then from that point, we can give you those numbers from our side, and give you at least kind of a hard number or a range of where we think it's going to sell at. And then we can figure out what the end result on the numbers are going to look like for the home purchase, if they're moving up or moving down, so to speak. Right. So. And a lot of times it really works out well for people, especially if they have debt. They can pay off some debt in the meantime, as well as carrying over some of their equity into the next home. So there's a lot easy to go about it.
If you have equity in your home, there's tons of options, that we can look at. We can look at pulling money out of your current home to buy your next. We can look at selling. We can look at renting out your current home, so you can grow equity on 2 different properties. So that's where we come in, and we literally lay out all the numbers for you. So
great. All right. Doesn't look like we have any questions yet. So thanks for joining us, guys. Angelica and the rest of you for joining us. And we'll be here every Wednesday at 1:30. And if you guys have any questions between now and then, you can always message us through here. Evan, how do they get in contact with you?
You can go to modernhomelending.com, or you can reach me 602-456-2273. All my contact information is on the website as well. So.
Awesome. You can go to Mincolla Homes or MincollaGroup.com, and it's 480-788-8569. We'll see you guys next time. Thanks, Evan.
Cool. Thanks, Chris. We'll see ya.